Your customer's confused, but it says right on the thing. It does? Oh, well, that's confusing. It was updated. This year, Halloween for on a weekend. Wow, the coffee's strong this morning. So, g'day, mate. How are ya? How's your mum? Hello, hello, hello. Welcome to Forex.Today, the YouTube community of almost 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of moi helping toi put together trade plans. Let's get on with it. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Hey, more trading every day, huh? Isn't that interesting? Every single day, all night. The last thing I was looking at before I went to bed were charts. The first thing I looked at this morning was charts, and now I've been looking at charts, even got some trades. And the day's only begun over and over and over again. So you know what? I think you need to enjoy what you do. Luis says, hey, Japanese yen hit a 20-year low against the USD. Cool. Good thing I'm shorting Japanese yen. Cool. Anywho, ask questions, get involved, and I will share from my experience. That's the best way. I've been doing live streams like this for 18 and a half years, I guess. Something like that. Cool. Another way to learn is you could buy my book on Amazon.com, Strategic and Tactical Forex Trading. The link is in the description below. You can take free training courses. The link is in the description below. It gives you the basics. It's pretty good. Okay. And they're free. The link is in the description below. If you like those free videos and you're like, man, I want more of this, there's 65 hours of premium high-quality training videos at fxbootcamp.com for $88 a year. I think that might even be cheaper than the book. Anyways, a link to fxbootcamp.com. If you can't figure out the fxbootcamp.com part, the link is in the description below. And then lastly, you're going to need a foreign exchange broker. I recommend tradersway.com. I believe they're an ethical trading firm. I believe their fees are competitive. I know their execution speed is fast, and I know their swaps are bigger than most. So check them out, tradersway.com. But ultimately, they have to earn your loyalty and respect. Tradersway.com. Here he is. Cool. Swissy week. Dollar strong. Ha 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 ha. That's what we've been talking about, huh? Anyways, yen's still weak. Swissy's still weak. So these are things that are have been for the last few days at least. Some pretty good shorting opportunities. Pound I've been kind of wrong on, where it was weak and I thought it would continue to be weak. And then it went strong. Then it went weak. And then it's strong. Oh, but Boris Johnson and my whatever, dude. Okay, so that one's got more volatility with it than I would have cared for. Okay, Aussie up, great. Euro up, great. CAD, yen up, great. And dollar recovering, great. So all of that's golden. So most of it has worked out. So that's good. hopefully that you've used all that information as a basis to set up your trades. Looking at here, you will see that yes, indeed, the RBA raised interest rates by more than expected, and now they're at 0.85, which is great. Okay. And Aussie has been, pretty reasonably strong. If we look at like, well, I guess we'll have to isolate here. Okay. Aussie Kiwi and Aussie CAD, I don't really trade. Aussie dollar, I wouldn't have done that one. This one I did do, but is now collapsed into tomorrow's trade. But you'll see where we were. The news came out, and look at that jump, huh? From 95 to 96. And now we're all the way back to 95. And here's the interesting thing. I've trained many of you over the years. And one of the things I've trained you is to, when you get one of these with Aussie, to expect one of these. So you're like, yeah, makes sense. Cool. So now your decision is whether this trend continues. One I made up. Okay. Cool. So we got that one right. I prepared you for days. I prepared you for days. Look at the volatility over here. Okay, which means after the RBA decision, we were way down at the bottom, and now we've had 100% retracement back up on the daily candle. Wowzer. Sucks, huh? El crapo. But anyways, anywho. So one of the things I asked the day trading group to do is review the statement at the RBA and try to read into it. What are they saying about the future? More rate hikes coming, or is that it for a while? Okay, so anyways, cool beans. Okay, yeah, cool beans. But notice that in here, if you see this, there's that Aussie move. But what's been consistent here is kitty cat. And so that was another trade or currency pair that I've been recommending recently. And so you can see a lot of these have been playing out well. Kitty cat fairly strong, stronger than the euro. Remember, Europe has to pay high oil prices. Canada gets that money, so money flows from Europe to Canada. Money is flowing from the UK. They have to pay high energy prices, and that flows to Canada. Canada's stronger than Aussie. Maybe oil's going up, but gold ain't. Canada's stronger than New Zealand. Milk prices are actually down, but anyways, I think these are indirect flows, but nonetheless. And then CAD, Swiss franc. Sky Killer says, hey, shouldn't commodity prices get weaker during summer quarters? Maybe, but also this year is not, it's not a typical year. So, for example, if we go back to Aussie, okay, Aussie's been going up since the middle of May. That was supposed to happen in April. So things could be shifting over a month. Okay. 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 Like you see this downward move? Typically, that month is the exact opposite. A big up, not a big down. So maybe this happens now? Yeah, could be. Could be. Although I'm thinking this will continue to be strong. And I've been, as the dollar's been weak, I've been preparing y'all to be prepared for USD strength. And again, I don't know why that's there. Great. I prefer Swiss franc to be weak, so this could be a good trade for y'all. So you can see it's a basic swing trade. That predicts that. You know, you probably want to respect in here. Okay. So to parity again. To parity and beyond. Or at least back. So Sky Killer says, so maybe this year, not the third week of August or third week of September. Oh my God. Dude, where have you been? I've covered that 100 times in the last 6 months. So I already answered that question 6 months, more than 6 months ago. 7 or 8 months ago, I already did that outline, Sky Killer. Where you been? So the easy answer to your question is, so maybe this year, not third weekend of August. Well, not maybe, absolutely, totally, for sure, not the third week of August. Where you been? Huh? You've been seeing some other YouTube guru, haven't you? Don't lie to me. Honestly, sometimes, Sky Killer, I don't know who you are anymore. Yeah, you joined the military. Yeah. Who'd you join? Hey, Jim, it depends on whose army. Yeah. The Portuguese army, very interesting. Yeah, I don't know a lot about the history of the Portuguese military. I should probably Google it. All right, so anyways, anywho. Nice little pullback M2, predicting M4, or at least back to the top. Back to reality. Oh, there goes gravity. Opie-do-babbity. There goes mom's spaghetti. I don't like confetti. All right. So anyways, dollar strong here, right? So you want to look for dollar strong, dollar strong, dollar strong, dollar strong, dollar strong. And looking at some of these, you can see I set these up on a daily chart, not a smaller time frame. And so if you kind of flush this out a little bit on a 4 hour, okay. And by the way, again, in the day trading group, we were talking about these things last week. Now it's happening. And that's the point, right? Like, you have to be able to plan for these in advance. Okay. And now if that comes to fruition, which is a type of Head and Shoulders. Then you want to look at a neckline, and your next real trade will be this. Okay, so you're looking for lower low, lower high, sell, lower low. So you can try to jump in soon, but it could be a week from now. Sky Killer's talking about, the United States was in a police action with the United Nations involved in South Vietnam and a little bit of North Vietnam, a little bit of Laos, and a little bit of Cambodia maybe. But anyways, the Portuguese thought it would be a good idea to go to Mozambique. Yeah, no, I know what you're saying. And yeah. I can just see the politicians sitting around there like, you know what we need to do? Let's go to Mozambique. Maybe they should have built an economy, a domestic economy. So, anyways, interesting. I'll Google that on Portuguese military history. So anyways, dollar I've been thinking about a lot lately. Swiss franc I've been thinking about a lot lately. Yen, obviously. Well, this is from a discussion the other day. Let me change this up here. Okay, all yens are up. Aussie yen was very up and now has given back, and I probably should snap another one in there, right? My choices here on the 4H is buy it at 95 or buy it down here at 94.50. So there's a little opportunity right where he is. Okay. So it went up 100 pips, came down 50%. And now is in tomorrow's buy zone. There's still room to the upside. Some of these, I shied away from Euro and I shied away from CAD only because we were here and we were here. And both of those are cautionary tales for potential profit taking. But what I said is this one still had room, this one still had room, and this one's well, this is WTI, so I guess I should kill that one to make it less confusing. Okay. The other one still had room to the upside. And so if they're going to go here, then these will break. But still, you might say, well, Wayne, you left all this money on the table. I'm like, yeah, but this is an out, not an in. And what you have to understand is I would venture to guess probably 70% of the time, it's better to get out than stay in. And so you're like, well, you left this on the table. I'm like, yeah, but that only occurs 30% of the time. I'm not really interested in odds like that. Okay. Anurag says, hey, I'm in a CAD Swissy trade, but what's the likelihood in the few hours, blah, blah. I'm not going to answer that for you. Those are your decisions. But let me tell you a decision for CAD Swissy. Okay. Currently, currently Switzerland pays you 0.75% per year because their interest rate is actually negative, but you borrow the money and they pay you. That's why I put it as a plus. And then you convert that into CAD, which pays, I don't recall off the top of my head. But the issue is there is a positive carry because Canada pays you an interest rate, but at the end of the week, they're going to raise interest rates even more. And that creates, in anticipation of getting a pay raise, the value of this asset, your Canadian currency, appreciates. So you get an asset appreciation over here, okay, plus a future expected income increase. Yeah, 1%. I was going to throw down 1, but then I was like, are they 1.5 yet or whatever? All right. So anyways, so you're earning 1.75% in a world where just a year ago, everything was 0. And this will probably go to 1.5%, which is well over, right? So now we're talking 2.25 plus asset appreciation and really depreciation since you're borrowing this and converting that and increasing the amount of Swiss francs in the interbanking system. So like what's going to happen in the next couple hours? I don't know, dude. But by the end of the week, I would expect it to be higher than it is now. And that could lead to a trend that continues for a while. Okay. Now, if you want short-term analysis, we can do it, of course. Okay. And, okay, this is an exit and this is an exit. You didn't take the first one, so I don't think you're going to take the second one. And so you might as well stay in it. Well, I won't. I'll take that back. You'll need to make a decision for yourself. But what you would do normally is you would look at this and, okay, and say somewhere in there is your buy zone. Or what I would say to myself is, okay, I can add to this position and treat this one last trade as an independent trade because the likelihood of it doing this is dramatically higher at this exit zone than in other prices. But that doesn't mean I want to exit this, or this, or maybe it does. I have to make that decision. One way to make that decision is say, well, which trade is which? Okay. So for example, if you're still in trades from this area, the target for those trades is 79. Okay. The target for this trade is 77.5, where we are now. Okay. So this one is going up here. This one's going up here. And then the last independent trade is just a pissy little day trade. And you're hoping for this, but can for sure get that. And then if you get the down instead of the up, first of all, you'll be out of the pissy little day trade. But then what do you do with this weekly trade? will probably jam your stop here and get out on the lower low and take that price just above the R1. But then these trades you might stay in still. So you might have stops down here. Okay, let's do this in bright, right? Okay, you might have stops down here from these trades, stops here for the weekly trades, and then stops about here for the day trade. Meanwhile, it just might do what you really are hoping for, of course, and that's to go to the monthly target, in which you'd probably take all this up. Now, because this is an R1 and it's an R2, it's an MR1, weekly R2, you could justify and say, well, Wayne, this could be the end altogether. And especially if you're treating this like an S1, R1 month, okay? I get your thought process there. So in that case, what you would do is you would take these stops, okay? And you'd mix them in here. And so now these trades have stops, these trades have stops, and now you're going for the higher high. But if it collapses, you're out of your day trade, your weekly trades, and your monthly trades. And you might just be done for a while. Oh, they finally let you out of the mind, Raymond? They felt bad. They're like, let him out for a while. Let him see the sun. Down in a hole, losing control. Down in a hole. I like to fly. That's a song from, who is that? Who sings that song? Alice in Chains? Down in a Hole? Is that an Alice in Chains song? Thanks a lot for the detailed answer. Hey, if anything, I'm detailed. So my kids don't even ask me questions anymore. They don't come to me for homework. I'm like, why don't you ask me about homework? Because they'll ask what time it is. And I'm like, well, did you know? And they're like, oh, dude. So yeah, you're going to get it detailed, right? No holes, huh? Jim says, love our new spreadsheet. Well, good. Maybe you should present it to the group and show what kind of changes you made. Maybe you'll be able to inspire others. But it's this idea that I'm trying to get people to think more and more why things are happening. Okay, so like you look at this and you think to yourself, well, Euro Swissy had been falling for weeks and we got down to 102. And what our assumption was, and our base case assumption in our model, is the closer we get to 1.00, the more likely Swiss National Bank is going to intervene, which would weaken the Swiss franc. Cool. Also, generally speaking, I spent days explaining in regards to oil why oil should go up, from 4, 5, 6 different angles of explanation, from 4 or 5 different sources of information. I even did mock simulation of how to explain it to a client, that you were forward looking and came out with things like oil, and that at some point oil would go up and CAD should benefit. And then you put these kinds of things together and you'll see there's quite a confluence of these things happening around that time. Now, is it just one big thing, and can you just say, aha, I told you so, I know it? No, but there are series, more than one line of thought. There's a series of different lines of thought. And this has nothing to do with CAD. Richard says, dang, I missed that one. But it's not just the CAD Swissy. That's where I want you to get away from the thought of a pair. What I've been pushing really hard the last few weeks, and I did that because for a while there, the opposite of what should be happening was happening, and that's probably just a mean reversion on some bigger time frame, but likely there would be a continuation, a continuity in the Y, and so on the short run there was a lack of continuity, and now we're returned to continuity. And so how do you put all of this together? Well, you need to first of all isolate Swiss franc and become a master of that. And by a master of that, you're just like, well, the Swiss National Bank wants that to be weak and it's strong. So at what point will they intervene and make it weak? And it dropped to 102 and you're like, yeah. Okay. Somewhere around there. But now that's across the board. That's a funding currency. So you wake up in the morning and you want to sell the Swiss franc. Okay, that's that. Now, then you go through the whole motions again, and you don't look at Swiss franc. Who cares? Okay, you've isolated that. You made a different decision, and now you focus on the CAD. What kind of economy does Canada have? For example, are they an X economy or are they an M economy? And then based on that, what are prices like for the X? What are prices like for the M? Who are the major trading partners and what is the health of those economies? Do you think that their economy, the Canadian economy, will improve or disimprove relative to how their major trading partners are doing? Whether those trading partners are supplying the M or offering opportunities for the X. And then you analyze and you do this and you do that and you make decisions and you come out of it with, you like to buy the CAD. Now, day traders can attest. There's more than a dozen people here in the day trading group that can attest that when the CAD was weak, I didn't want to sell it. I didn't even want to look at it. I'm like, yep, CAD's weak. Don't want to look at it. Don't want to talk about it. Don't want to put up a chart. Yeah, I see I can sell it and make money. I don't want to do it. Because it didn't make sense to me of why it was weak. To me, it was more like profit taking and the market was doing a mean reversion. But my job is to trade the trend. And so then as soon as the Canadian dollar gets strong again, I'm game on. But the thing is, I understand why. And in this case, it's an X economy. Okay? And I'm waiting for opportunities when export prices go high. And then, okay, meanwhile, I'm bearish. I'm bearish on the Swiss franc. And you put these together and you're like, oh, so again, weeks and weeks and weeks ago, in the day, was it the day trading group or the swing trading group? I always forget. We busted out a group spreadsheet and we started grading currencies based on things like inflation and interest rates and various other things. so that you can say, I'm a plus on this and I'm a negative on that, and therefore long. Okay. And therefore, you might be thinking this for the whole month of June. Okay. And by the way, that's what we were doing before June hit. We were in May. And if you were a bull, that would be your target. But you have to get there. See, I think trading, the value you create is that trade plan and having a logic behind it. That's all. I think that's 90% of your value. Okay. Okay, that makes you a boss. Okay, there's two types of currency traders. I know you're going to hate this. One is the coal mine owner, and the other one is the coal miner. One is down in the dirt digging picks and axes and gets paid by the hour, and the other one just shows up and yells at people, picks up the money, and goes home. So anyways, your value isn't the digging in the dirt. Your value is the ownership. Cool. Do 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 boo boo boo. Okay. Well, remember though, Richard, the Central Bank of Switzerland wants a weak Swiss franc. So you have to understand their objectives. So will the Swiss National Bank raise interest rates? Not until they're certain the ECB has raised interest rates. So they might as well wait until the ECB meeting, where the ECB meeting, they announce an end to bond purchases and the incredibly high likelihood of a July interest rate increase. And once the ECB has basically announced it, then the S&B can do their rate hike. And they should wait for the ECB to make the first move, because the reason the Swiss franc is paying negative 0.75 is because the ECB went negative, and they have to be more negative. So if the ECB decides to be less negative or even slightly positive, then the SNB can also be less negative, but remain less than the ECB. Okay. Down in a hole, losing control. Anurag says, hey, every trade we open up should either be for a buy or sell, and it must be backed by strong logic or support of the current analysis. Is that right? Well, anybody can make a trade for any reason. Okay? So we have to guess, if the vast majority of retail traders lose money, is it because they have lots of logic and intelligence and thoughtfulness put into their trades? Or is it possible the lack of thoughtfulness and analysis is part of their major problem? Now, there are many people here that have been following me for years still say fundamentals are nonsense. Okay, it's fine. I'm not here to tell you I'm better or right. But would it hurt to have thought analysis and thoughtfulness around your analysis? Would that hurt? Would that make you a worse trader? Some might argue yes. I'm not here to argue my point of view. I'm only here to share. So it's more like, well, that's for you to decide. I've always argued that it's healthy to have a balance between technical and fundamental analysis. That's all. Okay. But, okay. Now we go into here, and there might be a fundamental reason for down. Cool. But technically, okay, technical analysis right now matters more than fundamentals because the fundamental move has already occurred. And now we're at technical support, which is a threat to your fundamental move. So now we really need to dive in on our EuroCAD and really pay attention to these price levels because pop, okay, it could go up. And if I could be facetious here, I would say that's fundamentally wrong, but technically correct. The mayor says fundamental analysis is longer term. No. I mean, yes, but no. Okay. The major difference is, I think, that fundamentals create a trend, and there are times when the price action is moving up. And my whole book talks about this. That's the whole topic of my book. Okay, all downtrends have periods of up. And I spent years trying to figure out, well, what do I do? How do I know? Okay. But another fancy way of looking at that is to say, okay, what's the trend and what's the definition of a trend? Well, it's the mean or average, okay? But that's a flat number, so you want to do the mean over time, okay? Which means you have to have some sort of change, 0.1, 0.2, 0.3. So the way we do that math then is plot the mean, plot the mean, plot the mean, and look at the change. Okay? If it's, okay? Okay? And that gives you a slope. Okay? And then you look at the variance over time, variance, variance. Okay, you want to look at how far from the mean, so you get the mean and you get the slope of the mean. So you get your mean, and then you get your slope, and then you look at variance, which is sort of like measures of very often how high does it go and how low does it go, and variance is this way in the data set, okay? And then you calculate standard deviation. Does anybody know how to then do the calculation of the standard deviation when you know the mean, the slope, and the variance? Okay, the next one would be to calculate your standard deviation. Does anybody know how to do what the formula is with using these variables? Type in a question mark if you don't know, but you're listening. Okay, so you take your variance, which is like an alpha, but it's not alpha, right? What's a variance, covariance, and stuff? Okay, you take your variance and you square root it. To square root of the variance gives you your standard deviation. So what it ends up telling you is, based on all these variances, the deviation typically is this distant. Okay? Okay? So you're doing all this math because all it is statistics. What we do is statistics. And then, of course, a lot of this data you would use for an oscillator, and the oscillator is kind of telling you the same thing, using a different math, and then you can use MACD, and it's telling you the same thing, but using a slightly different math. And then you could do like Fibonacci to this, to this, to this, and there's a lot of different things you're doing. Okay? So it's important, I think, the fundamentals are giving you based on what you understand of global macroeconomics. You're looking at the flow of money. Darko's pissed off. God dang it! Huh? Darko? Yeah, you should know. Yeah, but 20 years ago. Well, all right, maybe click the thumbs up button. You're like, what a good coach. We just looked at the mean, the slope of the mean, the variance, and the standard deviation to do now a mean regression. Okay? So what I'm getting at here is we do all this fun math. By the way, are you getting this kind of detail from your other gurus on YouTube? Okay. Honestly, I don't know, but it'd be interesting. Like, really? So I had to do all this math in class. Like, okay, what's the mean? What's the slope of the mean? What's the variance? Now that you got the variance, you do the standard deviation. Okay. But anyways, what I'm getting at is that there are periods when price is moving up, and on the smaller time frames, an amateur trader might say, oh, it is bullish now. That is true. But what you might be looking at is an upward move that, if you analyze it, is just a reversion back to the mean, which is expected because it's probably off of a deviation that is standardized. Typically it does. And very often what happens is then the smaller term trader is blindsided by some of this stuff. Okay? And all I'm trying to say is, dude, all of this is difficult. Okay? That's all I'm trying to say. This is very difficult. And I'm trying to show you ways to simplify. So you could say your fundamental analysis of EuroCAD suggests that a mean, the slope, the variance, and the standard deviation all makes you bearish. And the rationale is Europe has to send money to Canada to buy oil, and oil prices are high, and that's bad for Europe and good for Canada, whatever. And you make a decision. And then you're using your technical analysis like a statistician. See, a lot of newer traders use their technical analysis like it's voodoo magic. Like it's predicting the future. You're like, whoa, dude. Why did you buy that? MACD told me to. No, MACD is an algorithm that helps you do statistical analysis. Well, why do you do statistical analysis? Well, so it can predict the future. No. So that you can eliminate poor decisions and increase your consistency. So you did fundamental analysis first, and you said EuroCAD down. You predicted the future. And then you say, okay, we're one standard deviation from my mean, and there's probably going to be a reversion back to the mean. So I want to stay out here. And then when we're back close to the mean, you want to look for new opportunities. And by the way, when I was drawing this, I wasn't paying attention to the actual price action, but let's just go with it. Okay. And then, so you sell because you're only a bear because of your analysis. Then it dropped and you get too far. You get beyond one standard deviation. You get to two standard deviations. So what is it? 1.68. And what's the other one? 2.33. 1 and 2 standard deviations from the mean. So you get 1 to 2 standard deviations from the mean, and you're like, well, I should probably take some profit here. Oh, and it's a monthly pivot, right? And then you avoid this. Now, an amateur trader would say, well, it's been going up for days, so it's bullish. You're like, no, it's not. Because Europe still has to pay Canada money. And exports or imports, okay, imports are up from Europe, which means they're exporting their money, and exports from Canada means that money is being imported. So money is going into Canada and money is leaving Europe, and therefore this should fall. So then you kind of regroup somewhere around the mean, and you're like, it's going to head back down again. And then you get 1 or 2 standard deviations away, price actions change, and you take your profit, and so on and so forth. Versus only technical analysis, because very often what happens with technical analysis is you're one trade late. So you would have bought this, taken a loss here. So let's say you bought this, took a loss here, and then you sold that, okay? And this will go until that changes direction. So you would have sold here, lost money, and then you bought here and you're back in. You're always giving some money back. You're right. You think of it. If there are 5 trades, your last one's a loser, and then it goes back down the other way, and then right, your last one's a loser. But that means 2 out of 5 trades are losers. Now, if your risk reward is proper, you're still profitable. But one of the things I thought about a lot in the early days when I ran into this conundrum, why are 2 out of 5 trades losers? I'm doing good technical analysis. Well, pure technical analysis is difficult to predict the end. All you can know is it's trending, and then you're like, oh, it stopped trending. But then it gets worse where if it doesn't reverse, it consolidates. I found all of a sudden I might have 3 out of 5 winners, and then it consolidates. And then whether I'm buying or selling, they ended up either being break even or losers. I found consolidation periods were worse for me. I don't know about you, but consolidation is the killer, not reversal. And so all of a sudden, then let's say 5 out of 5 are either losers or break even. And then it starts skewing my numbers quite poorly. And then I'm like, how do I create a mathematical way to address all of this? Because I want to, at the end of the day, my absolute return should go up. I don't really care what I do. If I trade more, if I trade less, I don't really care as long as I make more money at the end of the year. And I found if I cut out some of the variance, meaning I'm only trading down in a downtrend and I'm not trading up in a downtrend, then instead of having, because you still never really know the end. I mean, pivots can help you, but like go with the argument now, if I'm trading both ways and there's 5 trades in every move. Now you might say, well, Wayne, I'm Elliott Wave Guy. It's 5 and then it's 3 and then it's 5. Go with me here with this idea. If I cut out the multi-directional aspect of technical only, then I improve from, instead of 3 out of 5 winners, I get 4 out of 5 winners, but I'm also trading less. And now what's the upside of that? portfolio volatility goes down, Sharpe ratio improves, consistency improves, average loser improves, average winner is still good, number of losers improves. And all of a sudden, statistically, which is all of this is statistical analysis, not only does the trading improve, but the trading results improve. It just looks better. But ultimately, you may end up working less on trading. And what do you spend your extra free time on? Well, if you're trading less, you're spending more time analyzing, is this supposed to go up or down? Okay, X minus M. Boy, this is my mouse. Wow. Okay, so these are importers, these are exporters. Okay, you have to think about that relationship. What are they importing, and what are prices like, and how will that impact these economy? So oil goes this way. Okay, euro goes this way. Okay, goes to the ECB, who converts that to CAD, and now the money goes here. So now what? The supply of euro supply has gone up. How do I express that? I express it this way. Let's do it this way. Okay. The demand for euro, okay, and we'll fix that. D prime is this way. Price and quantity, and euro market. See, you have to label your charts. Okay, great. The second thing is the supply. Okay. So if we're looking at Q, which is supply, quantity, you have 1, 2, 3, 4, 5, and so on. 6, 7 trillion or whatever you want. Okay? And price goes up this way. So what's the equilibrium? Right now, the old price is at around 5, or the quantity is at 5. And we want that quantity to go to 7. Which means there's a shift in the curve. And I'm going to do this actually with a horizontal line. Okay. And now the new quantity, it's actually 6 1/4. Okay. The new quantity is 6 1/4. Okay. And we have price, okay, at equilibrium. Okay. This is quantity at equilibrium. And now you have the new price, P2, from the original PE, and the value of the euro has fallen as the quantity. So I will put it here. So the change in the euro market was described as the quantity increased and the price of the euro decreased. David says, hey, Wayne, with swing trades, do you adjust the limit orders during the day? You mean to get in or to get out? The answer generally would be, do I change the limit order to get in? No, because it's a trade plan you set days and days before it happened. Are you talking about the exit now for profit? Probably not, unless you really believe. And there are times when it is appropriate. Only if you believe the new move is extraordinary. That for whatever reason, not only are you going to go to this zone, but you're going to go way beyond it. Well, you'd have to have a pretty good explanation why you would throw away statistical analysis. Because these pivot points, for example, are just another mean or a way to measure kind of the same thing. What is the mean? Okay. This is not a mean, by the way. It's a weighted mean. So you can almost say, like, if you added up the weighted means, there's kind of a slope to them. Okay. How far does it typically deviate from that mean? So you could say, well, that's support and that's resistance. So it's a form of, okay, variance. Okay, variance, it's looking here and here and here and here. And then how far does it tend to vary? Well, it looks like here. Okay, which means the standard deviation is, basically that, because it's not trending. And then we do some other analysis and say, well, if this is a standard deviation, this is 2 standard deviations. Okay, if that's 1 deviation, this is 2 deviations. Okay, great. And then you want to go through and say, well, what's the 50% mark between these deviations? So you take your S1, S2, add them together, divide by 2, and you get this number. You take S1 central pivot, add them together, divided by 2, and you get this number. You take central pivot and R1, add those 2 numbers together, divide them by 2, and you get this number. And then you take the distance between R1 and R2, add those 2 things together, divide it by 2, and you get here. And you can say, well, it's kind of the same, but you're locking in the period and you're taking out the slope. You're taking out the trend and you're locking in more of the deviation than you are the direction. Cool, right? Look at that. I just went through the entire pivot point formula, building on the ideas that we just talked, and that is mean, slope, variance. And in this case, there's no, the difference between variance and standard deviation is basically 0 because there's no trend, there is no slope. If without slope, the variance is this, right? This is, and this is that. Isn't that nice? I'm scaring you guys off. There's half as many people here listening right now than normal. And I'm not shocked, but I find it disappointing because I think knowing the math behind what we do is important. In particular, if you're going to talk to professional investors about investing into your trading business. Now think about what a sophisticated investor is going to ask you, and think about what they're going to look at in your trading history. Because you might just say, look, I made 25% last year. That's not incredibly relevant to what a sophisticated investor is going to look at. Okay, they're going to look at your Sharpe ratio. Okay. Okay, so they're going to look at your 25% and then look at your volatility or your variance, which is another measure of volatility, very similar, or your standard deviation. So you're like volatility, variation, or standard deviation. So now you're thinking, okay, there's some sort of measure of vol, maybe peak to valley, variance, which is the measure of multiple peak to valleys, or the standard deviation of the variance, which is multiple versions of vol. Oh my God, now we're getting somewhere. So you get some ratio, which is risk-adjusted performance. But then they might look at value at risk. Has anyone heard of this? So you take your track record. Okay, this is break even. You had some losing months, you had some winning months. Most months were small, some were big, some were terrible, some were break even, above and below. So you want to look at the variation of all of this and then standardize the variation. So, right? So maybe all percentage. And you reorganize this by your worst days, right? Birthdays are the worst days. And now you're going to look at something like this and say, well, my worst periods of this is profit, this is break even. These are your losses. These are your wins. Okay, let's say months. And what do you want to look at? Well, is it a normal distribution? Okay, what's the variance? If you want to square it, then you get your standard deviation. And then you want to look at sort of your worst. How bad are your worst periods inside of all of this? And we call these tails. And say, okay, 95% of the time, how bad are your worst days? And you might find that your worst days might add up to, I mean, think about it. This is why you want to play around with this stuff. You want your worst days to be like less than 1% loss. Okay? That's why you don't want big losers, because, you know, if these cluster together and you have 5 bad days that are -1 in a row, and by the way, your value at risk doesn't do that. That's a downfall to value at risk. But they're just saying, if you have, if tomorrow is a bad day, how much money am I going to lose? And what you want to look at based on your history is your worst days should be 1, 1.5. So if you have a bad week and they're all losing days, you have a 5% drawdown. What your investor wants to look at is, if you had a few of these wrapped around, you look at your value at risk, and then you might multiply that by 5 and say, what is your worst week possible based on how you've been trading? You'll find that that might be a 25% drawdown. If your value at risk is like 4.5, you're like, dude, we could have a week with a 25, somewhere between 20 and 25% drawdown. Not interested, pass. But you're like, but I'm profitable. Well, we did another version of risk-adjusted performance, and then we're like, we don't want to take that level of risk that your volatility is showing. Okay? And then if they do invest, because it shows that your worst week would be 5, with 5 losing days in a row, with your VAR at 1, then you're like, okay, great. But then you do go through a week like that and you lose 8% and not 5, but statistical analysis at that snapshot when they invested showed -5, but you produced a -8, then you have a fat tail. And this poses some new problems statistically. And meanwhile, you're going to tell me this math stuff is stupid. I don't need to know this crap, Wayne. I just want to know what to do when the stochastics crosses up. And I'm telling you, well, even if you're making money and you're quite good as a trader, you're probably going to need to sit down one day with clients that want to invest money with you, because one of the key ingredients for how much money you make at the end of the year is assets under management. And you can enhance your assets under management with opium, other people's money. Now, you only get to keep 20 or 30% of that. Okay? But it's like having 20 or 30% more assets under management. And I mean, really, right? Because there's time and there's your assets under management. So let's say on day 1, you start with $10,000. Where are you going to be in 1 year if you are making 2% a month? You can do that calculation, right? But what if you started with not $10,000, $1,000? Okay. Well, the math might produce the more, but the thing is your account grows exponentially, not linearly, because you're also increasing your lot size over time. So what people with a little bit of money do, they say, I don't have much money, and for some reason you want to get rich quick, so there's no time. So you don't have time, you don't have many money, so what you want to do is you want to go for 20% a month or 200% a month by increasing your leverage relative to your lot size, and you go broke. So what you'll figure out very quickly, if you don't want to if this is fixed, so we'll say, right, 2% bar, you're only going to go for 2% no matter what, which means you can't risk much to get to the 2% because you're worried about your worst month shouldn't be more than 2%. Okay, whatever. Okay, so you're going for 2%, but that's not enough money. So you have two variables, time and assets under management. Well, if you're looking at this from the long run, like a true business plan, you're not worried about today, tomorrow, this week, this month, this quarter. You're thinking about years, and right? Then you're like, well, time is kind of fixed. So if time is fixed and your monthly goal is fixed, but even if you hit your monthly goal, there's not enough money to live on, or you're not growing your account fast enough, then your variable that you can adjust is your assets under management, which means you got to do a raise. You got to become a professional investor. And now you got to be able to talk about things like your Sharpe ratio and your value at risk, and talk intelligently about it. And be able to go through your own trades and explain it and love it. In fact, brag about it. Okay? And explain how your losses, right, give you such a great Sharpe ratio and a great VAR. Okay? That's one angle. Or do you understand your pivot points enough that you can just bang out an explanation like I did live on YouTube, where I'm just like, this is how you do all these calculations. Or here's all these technical calculations, statistically analyzing the time series of these prices regarding EuroCAD. And then more importantly, how does that fit based on the decision you've already made based on economic analysis of global money flow? And LIBOR says yes, and that's where I'm trying to get you. Okay? Yeah, Peter can. LIBOR says it can. That's cool. So it's important though, right? Peter, have you had to sit down with somebody and go over your VAR or your Sharpe or your Sorrentino or something? The key thing, like with a value at risk, is what if you run a portfolio of trading strategies? So now you got to think of it. You got to analyze all this risk and try to explain all the different risks combined together in a portfolio as a number. Yeah, Peter says, and they stare at you blankly. Well, your clients might change because I don't know who your clients are and all that kind of stuff. But I can tell you, if you're going to work with basically a family office or some other small institutional allocator, there's probably due diligence teams involved. Okay. They're going to send their risk officer your way and an auditor. Okay. And maybe a trader, but a team. And they don't give a crap about you. They walk in the room and what do they have on their mind? If they allow this investment to happen and you lose money, they could lose their job, but they'll certainly lose face. So they're going to come in and they hate you, Peter, because you're risk and they're risk officers. They hate risk. Their job is to protect the client from risk, and investing in you is inherently risky no matter what your return is. So right off the bat, they come in, they're like, Mr. Ward, I want to go through all your trades going back the last 5 years. And if you have more, we want to have all the trades if you can go back to 10. Okay? And they're going to go through all of this, and they're going to find 15 different ways to find how investing into you is not a good idea. Because that's their job. If they're a risk officer, is going to find risk. It's risky. But it's sort of like, the way it really works too is there's somebody that actually want to invest with you. So think of like life where you get this entrepreneur. He likes this idea. He wants to buy a company or something. And great. So he does a handshake deal with the company owner that he wants to buy it from. And then they send in the lawyers. And the lawyers are like, this is a bad deal. This is bad. This is bad. Right? This is not good. This is risky. This is risky. Well, the entrepreneur is like, okay, great. The entrepreneur can listen to the lawyer, but a lawyer's never going to do it. That's why a lawyer's a lawyer. An accountant will never do it. They're bean counters. They're not going to take risk. So the entrepreneur has to say, okay, I get it. Thank you for the feedback accounting team. Thank you for the feedback lawyer team. Now just get this shit done. Close the deal. Okay. So hopefully you got a client like that, but you got to understand, right, Peter, when these guys roll in, they're going to do all kinds of things to look at your value at risk and calculate it 9 different ways. Well, there's actually 3 different ways to calculate VAR, like using a Monte Carlo style simulation, but then they can go back in history and they can do things. And I'm not sure what they would do. And in fact, they could do it wrong. It doesn't matter. It still leads to the same decision. But what if they only calculated, right, Peter? They went through 10 years of your trading and looked at every single losing day you had over 10 years and then did a historical VAR off of that. Now you're like, well, that's BS. That's not how you do it. You're not showing any of the reward or upside or all that kind of stuff. And they're like, dude, we only care about the downside. So we're going to look at every day. Every single day, or maybe every single losing trade, and they just rip it out of your spreadsheet and put it into their own, start doing their own risk analysis. And they're like, Peter, well, if you go through all this crap, your VAR is low, where your VAR is high, right? Peter's like that, and all they know are mortgages and some yeah. Okay, so you're talking to like high net worth individuals, right? Not like a family office or something. You're right. You're doctors and lawyers and accountants, and they're difficult because they're arrogant, right? Most self-made millionaires and billionaires, they're like, dude, it was all hard work and quite a bit of luck. And business people know the value of having a team, where lawyers and doctors and accountants and chiropractors, it's all about them. They're the ones that made their success. So anyway, so they're sometimes hard to deal with. And then there's those that were born with money. That's a hard one to deal with too. Right? Where someone will come up to you and they're like, I want you to make, instead of 2% a month, I want 20% a month. I've had people tell me, I want you to make 100% a month. So you have to reverse engineer it. You're like, okay, well, I'm a conservative trader, but if you jack up the leverage to that extent, if you look at my value at risk, I can have a bad week and blow up the account. Right? Right? They're like, what value at VAR? What's VAR? Like, well, if you jack up risk that high, even a conservative trader, if something goes wrong, and anything can go wrong, Swiss National Bank intervenes. Whoops, I just blew up the account. Tsunami in Japan. Oh, sorry. See, that's the thing, right? So it's not like 95% of the time you won't lose money. It's more like this. Let's say you're growing your trading account. La 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 la. What happens if there's a black swan event? Do you lose 10% of your account or 100%? Now, as a sophisticated investor, wouldn't you like to know that? So you'd almost do a test, like a stress test that banks have to do. Do you know who invented value at risk? Banks. I believe JP Morgan was one of the first to start including, value at risk when like around the year 2000 or maybe even 2008. I think it was 2000, but let's say around 2008. Let's say that financial crisis, the Fed started asking banks to do stress tests and report the risk on their books. And banks kind of had various different ways of measuring this, but JP Morgan definitely used this value at risk model. And it started going on their books, and now everybody starts putting it on their books and reporting it to the Fed. And it's like, okay, what happens if there's a terrorist attack? You see? And that's kind of what the value at risk is. If this is how much money you're going to lose. And that's what a professional investor into your fund is probably going to look at. If things go bad, how bad is bad? Okay. Luckily, we're liquid in Forex. In many other investment vehicles, it's not. Liquidity could be an issue. Like if the stock market does this, you can't get out because there's nobody buying. Okay. So you have lack of liquidity, right? Yes, Peter's right. Yes, family offices that he's spoken to are successful at certain things and not very. Yes, so I know somebody right now, a fund doing a raise, and they're very successful because of how bad the stock market has performed lately. And because the cost of money is going up. So if you're a real estate investor, cost of borrowing is going up. So maybe you don't borrow as much, but you have this cash laying around to do deals. And that would be your sort of like if you're buying a house, you have to have 20% down, right? So that means you have to save. So even real estate developers, they might have I don't know, I'll make up a number, $1 billion laying around because they're going to do a $50 billion deal. Or if that sounds too big, just take a zero off. They have $100 million laying around and they want to do, $2 billion deal. And now cost of borrowing is going up. And the economy is uncertain. So maybe you don't do the development deal. You put that on hold, but now you still got $100 million laying around. Oh, well, let's put that in the Forex market. Why? Well, you don't want to put it in the bond market and you don't want to put it in the stock market. Okay. And then others, as Peter said, are already like a family office might already have their negative 10% right now for the year. And they're like, man, this was painful. The last 6 months were painful. And then Peter comes around. He's like, I can take some of that pain away. And they're like, you can? Yes. I can keep you liquid and I can earn income. So I can catch, if you want to be correlated to the stock market returning to an upward trend, I can do that. And we can remain liquid and I can earn income. So it's kind of like investing into the stock market and the bond market at the same time. A little bit of income, a little bit of asset appreciation. And by the way, I'm 3 and 30. Okay. Then they're like, well, then we don't want to pay 330. We want to pay 220. Okay, well, then I'm going to lock you in for a year. You can't redeem for a year minimum. It's all done. It's all negotiation. So anyways, I took up an hour and a half of your life. It's 1 hour. Boom. 1 hour and a half. All right. So I apologize for going ape crazy today on statistical analysis. I just gave you a lesson today, if we were to summarize this, on how to be a risk officer for a foreign exchange hedge fund. Okay, we did deep dive into the math. And I hate math. So if you hate math and I hate math, I think the greatest takeaway would be that you understood what I said and it made sense. And you're like, I hate math, but that was interesting. Then that was a huge victory. So I'll let you go to the 22-year-old foreign exchange trader who wants to earn a Lamborghini and place down some big trades and make some big money quick. I'll let you go watch them. And at the whole time say, even if they're making money, their VAR probably sucks. And that it's working today and then one day it won't. And that's dangerous. Try to figure it out. What's their Sharpe ratio? Okay. Okay. And just say, what do you want to do? Do you want to be like Peter that can sit down as a foreign exchange trader and talk with a family office about them investing into his ability to trade and have casual and sometimes detailed conversations about things like his Sharpe ratio and his value at risk? And sometimes it's from a threatening point of view where you have a due diligence team that comes in and they want to find bad things so that they can tell the client, don't invest, because that's the least risky thing, is not investing. That can be a problem. But you also might get a client that is asking you to do things that doesn't make sense, and you have to say, well, sir, ma'am, we could go for higher returns by increasing our leverage. That is something we can do in Forex very easily. But let me go through this concept used by bank stress testing, value at risk, and explain why that is a very bad idea. It looks great when things are normal. But if one thing unusual happens, it shows that very, very bad things can happen very, very quickly because we have risk leveraged against us, not for us. And you explain it, and they say, thank you so much. I appreciate your knowledge. You are a true professional, and God dang it, you're a beautiful person. And you say, I know, right? Have a great day. Smell you later, dog. That was real. That just happened.